Hi, everybody. Welcome back to the 10th of an hour with Griffin Bridgers. For today's episode, episode 94, we're going to look at flexible planning using a technique known as a sale to a grantor trust. Now, for those of you who have listened for a while, which is very few of you, you may recognize that I've done a talk on sales to grantor trusts in the past, but I'm doing this with a different angle. I'm kind of looking at it in the current planning environment and how flexibility can be built into this particular type of planning arrangement so as to adapt to future changes in law depending on speed of execution of the adaptation. Now, as always, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. So, both gifts and sales in the estate planning context have the goal of freezing the value of the estate. In other words, for example, if you make a gift, you're not really transferring the assets free of tax. You're still using up some gift tax exemption, and they're still used in your estate tax calculation as an adjusted taxable gift at death. However, even though they're in that calculation, it's the difference in value between the date of the transfer and the date of death that controls. It's assumed that assets will appreciate in value over time, so if you can freeze the value in the gross estate, you remove that future appreciation in the value of the property from the gross estate. Now, as I mentioned, with a gift, there is a gift tax consequence to it potentially, which is offset by a very large gift tax exclusion currently, but which could go down in the future, which will be a concern addressed with this technique. Now, this is also a strategy that can be accomplished through a sale of assets, but the problem with a sale of assets is that it could result in income tax liability. And with both of these types of transfers during life, the trade-off is that you lose the step-up in basis for the asset. Not only would the appreciation that accrues after the freeze transfer not get a step-up in basis and not be wiped out at death, but also any appreciation that accrued prior to the transfer would not either, unless you recognize income tax gain on the sale of the asset. And another big trade-off in a non-tax world is simply a loss of access to the transferred assets. So today we're going to look at a simple technique that's designed to avoid some of these issues. And this can be accomplished through the use of what's known as a sale to a grantor trust. So at least partially you can avoid both the gift and income tax issues. So as we've talked about in many previous episodes, a grantor trust is a trust that's ignored for income tax purposes because the grantor has retained certain rights or beneficial interests in that trust. Now, the big thing is that even though the grantor trust is ignored for income tax purposes, it is still respected for gift tax purposes, and because of that disparity, this type of trust is often known as a defective trust. So that means you can sell assets to the trust, and once the assets are in that trust, they won't be included in your gross estate, but you'll still be taxed on all of the income of that trust. So, there's a lot of issues that go into this, and we're going to kind of look at three phases in the life cycle and then bring it home with a little bit of how do we bring in the flexibility in today's uncertain tax environment. Well, first off, when you fund the grantor trust, the trust has to have assets or the ability to, at least pledge its creditworthiness to exchange equivalent value for what you're selling to the grantor trust. Otherwise, you run the risk that it's a gift and not a sale. So it helps first and foremost to have a qualified appraisal for the asset being sold if it's not an asset that can easily be valued, like a portfolio of marketable securities. So if you have like real estate or business interest, you have to get that appraised. Next, you need to look at the fact that the trust should have some down payment, some cash, some skin in the game for the IRS to respect this. Now, there's this weird figure that floats out there that's anecdotally recommended as a safe harbor, a 10% down payment, but this figure is not really supported by any IRS ruling or requirement, so you can go below that and be safe depending on the facts and circumstances. But the big thing is that this 10% down payment would be a gift to the trust, which is why I said you can't completely avoid gift tax consequence here. So this gift of the down payment would use up your gift tax exclusions first, before anything's paid out of pocket. Then finally, you need a promissory note that's enforceable under state law, where the trust pledges to pay the grantor back with adequate interest, maybe in installments over time. Now, importantly, the sale of the asset to the trust and the payment of installments back wouldn't be income tax events, because it's just like with the grantor trust, it's as if the grantor is selling assets from himself or herself to himself or herself. Similarly, interest payments back are really just payments from the grantor to the grantor. So those are not subject to income tax. Now, when it comes to administration, you need to note, this is where things go awry, is that the grantor still has to pay income tax on all income of the trust. So this isn't a perfect solution. You still have that situation of having to pay income tax, but it really means that the grantor is in no different of a position than they would have been had the asset been held onto and not transferred into a trust. Now, there could be some phantom income issues in there, and there could also be C Corp stock, which has a corporate level income tax plus a dividend tax when that taxed income comes out to pay the installments on the note. But the biggest picture item here to keep in mind is that the payment of the income tax on behalf of the trust beneficiaries would not be a gift to the trust beneficiaries by the grantor. So that's another added little tax loophole, quote unquote, built into the strategy. Now, the after-tax income is used to pay installments and interest on the note, which allows access to the assets on behalf of the grantor. The grantor could raid the trust to get paid back on the note, and the grantor's only loss of access is going to be to the post-sale appreciation in the value of the assets. And then, when the grantor dies, the only asset included in the grantor's gross estate will be the note, so long as the transaction is not recast as part gift, part sale, or full gift by the IRS. And a lot of that will depend on the appraisal, whether that was done up front and whether the IRS deems the sale to the trust to have been for the fair market value of the asset at the time. Now, in uncertain times, this is actually a more valuable strategy than a lot of people give it credit for, because there's a lot of uncertainty as to the $11.58 million gift and estate tax exclusion. It could sunset by 1/2 on January 1 of 2026, or it could sooner be changed by legislative action. So if that happens, if you are in a situation where you need to quickly use the gift exemption, the promissory note could simply be gifted right before this happens to use up some of that exemption. Now, the trade-off would be, upon that gift being made, the grantor loses access to those trust assets, and you also lose the step-up in basis as well. Now, if the exclusion might not go down, one thing you could do is, for income tax planning, is look at having the grantor, maybe shortly before death, have appreciated assets used to pay off the note, which wouldn't be an income tax event like it usually would, and that works better with something like an LLC interest. But the thing is, by doing that, those assets will now be in the grantor's gross estate, the value of the note will be reduced, and those assets will get a step up in basis. And then finally, another thing that's floating out there, a planning strategy that some people have talked about but hasn't really gained traction yet due to lack of IRS rulings, is converting the trust to a non-grantor trust, possibly to defer income taxes if you plan to sell the appreciated asset prior to death, but after transferring it to the trust. Now, this would be a sale to a third party, not the initial sale to the trust. Now, it's important to note there are some pitfalls with this. There's some 2-year related party rules you have to get around. There's the fact that you can't defer depreciation recapture. There's lots of pitfalls there, but that's a discussion for another time. But either way, lots of flexibility here to really call an audible down the road once this strategy is implemented. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. Thank you for listening to this episode of The 10th of an Hour, and I look forward to seeing you in the next one.